Are we good to go now? So you see that they will hide it somewhere. Now, in this case now, they are telling us that 20,000 ordinary share in what? In Danko. So that is the total number of shares they acquired in Danko. So what is the total number of share in Danko? What is total number of share in Danko? 25,000 naira, Abi? You don't understand? Okay, but we all know where we got that 20,000 ordinary share in Danko, Abi? Okay, just hold on. Can we go to under PPE? Can we see 20,000 ordinary share in Danko? Is it 20,000 or 20 million? 20 million ordinary share in
20
Danko.
million.
Can we all see that? That is what OPCO has acquired from Danko. Now, we want to know how many shares does that Danko have before the acquisition. Now, go to under equity. Can you see that now? Ordinary share of 1 naira each at 25 million. Can we see 25 million naira? Can we see 25 million at the front of Danko? Abi? Yes. We are all good with that. Now, if you notice, we see that they gave us how many shares? In shares, Abi. But this figure they are giving us, this 25 million naira, is in value. They are not in the same units. So we must convert both into the same units before we can proceed to calculate our what? So what we are going to do is that acquired shares in Danko is 20, let me just put it in short form, 20 million shares. Are we good to go with that? And total shares in Danko is, so we want to calculate total share in Danko now. The value of that is 25 million. Yes or no? Yeah. Then the nominal value is 1 naira. Are we getting that now? So which means that total shares they have will now be 25 million shares, million naira divided by 1 naira. Are we getting the gist? So what we are going to be having now is 25 million shares. Are we getting the gist? Now, to calculate our group structure now, it will now be, so therefore, 20 million shares over 25 million shares multiplied by what? 100%.
100.
So what will that be the total group? 80. So it means 80% is for the parents and NCI will be 20%.
20%.
Are we getting the gist? If it's on his way, tell him to join online. So that's what we should do. If you're on your way to physical, that is why we have physical and online. Just join online. Join online while you're on your way, so that you will not miss anything that is going on. Because you cannot predict traffic. Okay, so I'm sending this to the platform now, so that I can rub it. So since you have been able to get the group structure, you are good to go. The next step to take is what? After group structure, we need to calculate our goodwill according to our step-to-step, Abi. But in this case now, there are some elements we need in calculating that goodwill. We need purchase consideration, we need NCI, and we also need net assets. Okay, so all these figures are not given to us on a platter of gold. So let's go back to the question. Okay, so I'm going to run this now. We are done with first step. So for the second step now, we need to calculate or we need to get our purchase consideration. From that question, we have first one to be cash consideration, which is how much? Is it 30? 30 million naira. Are we getting that gist now? Now the other one is to be paid in 2 years' time, Abi. The date of acquisition is 1st of July 2018. So from 2018 to 2020 of July, that is 2 years. But they said they are going to pay a further what? 10 million naira.
10 million naira.
So we have contingent consideration. So this contingent consideration is what we want to calculate now. The first thing we need to know is that from July 2018 to July 2020, that is 2 years, I mean. Then there's cost of capital given to us to be 7%. What again? Then the cost is how much? 10 million naira.
10.
But this cost we are seeing is future what? Cost, which we need to discount into the current cost. So for us now, therefore, to get the present value cost of this figure, are we getting the gist? It's going to be 10 million naira multiplied by, what is the rate we normally use? What is the rate?
7%.
Abi? -2. We still remember now from PM. So what do we get now? Online, yeah, press calculator, press. They are waiting for you. Huh? 3 million, are you sure? What? Say something.
8,734,000.
8,734,387. 1.28. Are we all good with that? Yes. So we have this. Are you okay with the way?
No.
Oh, yeah. Well, are you okay now? Okay. So this is what we are saying is that this figure now is the contingent figure. They're going to pay in the next 2 years. Are we getting that gist now? So now our total purchase consideration now will now be what? This plus this, what do we get? Do I need to show that workings again? There's no need now. So just know you just make sure you know how to do that. So 30 plus 8, that should be giving us 38 something. 38, 734, 387.2. Any question online? Are we good to go? I believe there's no question. It's very clear. So what we have done now is that we have been able to get our purchase contribution. But don't forget, there's going to be elements of interest on this. And this figure is going to be future. So we are going to recognize it as liability. Are we getting that now? Because it's going to be under long-term liability, and you are going to recognize the interest as finance cost on that. So let's move on. Let me just snap this. Then we can move on from this aspect.
I have a question. Please, why are we recognizing it as liability?
Okay. You know, let's ask this question. Who is going to pay this 38 million? I mean, who is going to pay this 8 million naira? Who is going to pay this 8 million naira?
Is the Danko.
It's OPCO. It's OPCO that promised that we will pay you if we meet a certain target. Are you getting that now? So it's OPCO that will pay this figure in the next 2 years. So since you are going to make this one, you are going to pay this one in the next 2 years, you must take provision now, Abby, and start carrying it because it's an obligation to you already. So that's why you are going to recognize this one under when you are doing the group account. And who is going to make the group account? Is the parent. And it's the parent that is making the promise that we are going to pay in the next 2 years. Are we good to go? Online. That's the question is clear now, right?
Yes, sir.
Okay, so let's move on. Let me just share this one on the platform. Okay, so let's move on. So we have been able to get some of the elements that is giving us headache. We have gotten the group structure. We have gotten our purchase consideration now. So it means we can go to our goodwill, Abby. So we can set goodwill computation. And for goodwill computation, we need what we call purchase consideration. And what is our purchase consideration now? 38, 34, 387.28. Abby, if I like, I can throw away that one. Just that difference would be yes. Okay, so this is our purchase consideration now. Then the next thing to do is what? NCI. You still remember from our last. Now, the NCI can either be proportionate or fair value. But in this question now, they have already given us the group policy They said it is good policy to what? To value the NCI.
Value. At fair value.
So we must obey that instruction. And to obey that instruction, they even gave us the figure to use. What is that figure? 10 million naira.
10 million naira.
So what is the total? 48. Yes. 734 387.28. Any question with that? We are good. So the next aspect is what we call the net asset of sub. So from the net asset of the sub, we can get that directly from the question. But in this question, they did not give us directly, which means we need to calculate the net asset of the subsidiary. So from here we have, just go to the equity of the subsidiary. What are the items you can see there? We have ordinary shares,
Evaluations,
and retained earnings. So just 3 items there. So let's come here. Share capital, revaluation, and retained earnings. Now from here, what is the share capital? 25 million or so, are we? Don't forget, we are talking about net asset of subsidiary. So everything you want to bring here must be about the subsidiary. Then revaluation, how much? 5 billion. Now, don't forget, I said we have 2 components in this retained earnings you are seeing there. The first one is pre and post, have we? Yeah. But which one are we bringing under net asset here? Pre. Because pre is at the date of acquisition. And whatever whatever you are doing here is at the date of acquisition. Look at the gist now. So we are bringing pre, acquisition, retained earnings. And that was given at the beginning of that question. 6 million naira. Add it together, what do we get? That will give us 36, are we? 36. Are we good to go? What we should do now is that 48 minus 36 to get our goodwill. Yes or no? That should be what we should have done. But now, because this one is a bit different from the first class, we are now stepping it up bit by bit. Now, at the date of acquisition, the net asset they have was 36. But later, they now discovered that they omitted one of the assets that's supposed to be added to the net asset to increase the value. And what is that asset? The intangible asset, which is the brand name you are seeing there. And how much is that? 5 billion naira. So that 5 billion is supposed to increase the net assets of the subsidiary. So what do we call that? We call it fair value adjustment. And what is the name of that? Brand name, Abby? Is it? Okay, Dan and N-O, Abby? Dan and No, which is intangible asset. So 5 billion naira. So when you add it together, we are having what? 41 million. Do we have any other adjustments to make? No other adjustment again. They said there's no difference in share and revaluation, Abi. So it means everything still remains the same figure. So after this now, the next thing to get now is what we call what? Goodwill. So to get our goodwill is simple. All we just have to do is this figure, 48, which is the total purchase consideration and the NCR, minus the total net asset. What is the difference between the two? That is this minus this. What do we get? 7734. Okay, this figure, right? Okay, 1, 2, 3. This one. We should put this one in bracket. It's okay. Just know that, except if I'm bringing it to this place. Are we good to go? So now let me now ask this question. This 7734, what type of goodwill is this? Positive.
It's goodwill.
It's positive goodwill. Okay, so it's positive goodwill, Abi. And where are we going to report it? On the asset, Abi. But if it is
assets.
good. So what if it is negative? Where do we put it? Retain earnings of the parents.
Return
Fine. So are we good to go? Do we have any questions?
equity and yes.
Okay, so fine. Are we good to go? Any question? So let's move on. So you will see that in the group chat now, and then we can move on. So from that question, do we have any other thing to calculate? Do we have any other thing that we have not solved in that question? At least we have calculated our group structure. We have been able to get our, purchase consideration. We have been able to get our what? Our NCR, that is the fair value, which was given to us. We have been able to get our net assets. We have been able to get our goodwill. Yes or no? So what again are we supposed to do after that? What is the next information we have in the question?
Consolidated retain earning and NCI value.
NCI value, that will be
Share of
still additional code. Okay. Don't forget I said after you have been able to get your good structure, your goodwill, you get the consolidated retained earning, then you get the NCI value. So that's what it's trying to refer to. But that is if there's no additional information at all. You just go, you must just, there's no how. If either there is additional information or not, you must touch that first step. Do you understand? But now that there is additional information, we need to go ahead and solve that additional information. And that one is talking about intergroup, Abi. And what is the question saying? You can online just refresh us. Just read that last phrase of the question so that we will treat it. Anyone with us? The last phrase of the
OPCO acquired. Okay, last phase of the question.
I'm with you.
Okay. Should I pick it from that OPCO, sir?
Just read.
OPCO acquired. Okay.
I'm with
OPCO
you.
acquired. Okay, OPCO acquired its investment in Danco on 1st July 2018 when the retained earning of Danco stood at 6 million. The agreed consideration was 30 million, cash, and a further 10 million on 1st July 2020. If Danco attain certain profit targets, OPCO cost of capital is 7%. Danco has an internally developed brand name, which was valued at 5 million at the date of acquisition. There have been no changes in the share capital or revaluation surplus of Danco since that date. At 30th June 2019, Danco had invoiced OPCO for goods to the value of 2 million, which had not been received by OPCO. There is no impairment in goodwill. Okay, should I stop all?
Okay, thank you so much. So there's no impairment, so we don't need to go to the impairment aspect. But what we are saying, what I'm trying to introduce now is what we call intergroup sales. Okay, and in this intergroup sales, we'll be calculating unrealized profits if there is anything like that. But I don't want to go into that. It's too early. Let's take it step by step. I think this is the second question we are solving. So we have been able to introduce at least when the group structure is not given to you, you should be able to calculate the group structure yourself. Then last one, the one we did was just only cash consideration. But this, we have been able to add additional consideration, which is contingent. Okay. Then we also have fair value adjustment, which is 5 million naira. That is another adjustment. So now, after this, so let me just go back to that question and explain what it's saying. Let me go back to that question and explain what the question is saying. Okay. At 30th June 2019, Danco invoiced OPCO for goods to value how much? 2 million naira, which has not been received by OPCO. Here, the first thing you must be able to identify is the seller and the buyer. So in this question now, who is the seller? Is it Danco? Yes. Danco is the seller. Buyer is OPCO. Now, when there is unrealized profits, we are not going to unrealized, but I just want to explain that concept. When you are going to unrealized profit, that unrealized profit must be deducted from the seller. The seller should not be, the seller will have reported that profits in his own profit at the end of the year. So you now deduct it from the seller, not from the buyer. So it means if you want to calculate it now, that post-retained earning you want to share, you should reduce it by what? By that 2 million naira. If that 2 million naira is the profits. Are you getting the gist now? But this question will not affect any of those areas. It will only affect the intercompany payables and receivables. What Danco is owing, Danco has invoiced this 2 million naira to OPCO. So definitely this person will have added this 2 million naira as part of what? Receivables. That I want to receive additional 2 million naira from OPCO. Meanwhile, OPCO have not received this good. So if the receivable here is 10 million naira, including this 2 million naira, what will be Danko will be having as payable? Will be 8 million naira. I don't know, maybe we are getting the gist. I will take it again. The rule is that both intercompany must agree. But this one is saying 10 million naira you are owing me. Before it was 8 million naira. But there's an additional what? 2 million naira to make it 10 million naira. But this person will be saying, I want to pay 8 million naira to Danko. Danko will say, I want to receive 10 million naira from Opco. So the two figures are not the same thing. This is where the mistake, the error is coming. That is why this 2 million naira is in transit. It has not gotten to Opco. Do you understand now? So when you want to consolidate now, you must make sure you correct this mistake. And what you are going to do is simple. It's either you eliminate this 2 million naira and say that, see, this good has not been sold to Opco, or the Opco will recognize it by adding this one to what? To 2 million naira, so that it will be 10-10, so that both can net off each other. Or you reduce this by 2 million naira and don't adjust anything here, so that the two will be reading the same figure. Are we good to go now? That is just what that aspect is saying.
So I need more explanation.
You need more explanation.
Yes, sir. I didn't get that part very well.
Okay, no problem. Don't worry. We'll make sure we cover it. At least this class will end by 12, Abi. Yes. Okay, what we are saying is simple. We have two companies here. And I believe we have seen intercompany before. One person will be saying, I want to receive from you. Another person will be saying, I want to what? I want to pay you. For example, let's use this for example. For those who have not completed their lecture fee, me, I will recognize this as what? As receivables in my own account. While you that have not completed your lecture fee, you will record it as what? As payable. So if I say Mr. AB is owing me, that is, I want to receive from Mr. AB 8 million naira, then you also must recognize your payable to be 8 million naira. The two figures must be reading the same thing. So if the two figures are not reading the same thing, then we must reconcile it. We must make sure it's read the same thing when we are preparing our financial statement. And that is what we are doing here. Now, this person sell to Opco, Abi, and this is 2 million naira. These 2 million naira have not been recognized by Opco. So their figure is not reading the same thing. So for the figure to read the same thing, this one is saying, I want to receive from you. This one is saying, I want to pay you. I want to pay you. I want to receive from you. So it means there are two ways you can correct it. It's either you remove it from the person that is saying, I want to receive from you, or you will add it from the person that says, I want to pay you. Do you understand? It means someone is wrong. For example, if the normal fee, your balance is supposed to be 10,000, and I'm saying it's 20,000, it means one of us is wrong. So it's either I'm the one that did the wrong calculation, or the error is coming from you. So anyone that is doing the wrong calculation, then we must correct it. That is what is going to happen here. Is it clear now?
Yes, sir.
Yes, it's clear. So we are happy that it's clear. So after that now, there's what we call contingent liability. This contingent liability is as a result that there's a promise that they will pay in the next 2 years. So since they are going to pay in the next 2 years, they have to recognize that liability now. They're supposed to make provision now because the obligation is already there. So what are they going to do? What is the contingent consideration? Contingent consideration is 8 something, 871. Don't disturb my friend. She's always 100% in class. Please. Okay, so 87 what? 8734 387.28. That is the contingent liability. Now we need to calculate the interest. We call it finance cost. Don't forget, this figure you are seeing is as of today. We have discounted it to today's figure. Yes. But this figure will not be the same thing. This one is as at the date of acquisition. Are we getting it now? And we are preparing this financial statement as at when? 2020. Is it 2020 or 2020 or 2019? 2019, Abi. So it means if this figure is at the beginning of 2018, Abi, so at the end of 2019 now, that's 1 year, and we must recognize it and accrue, add this to what we promised to pay. We will continue to pay, we will continue to increase that contingent liability until it gets back to 10 million in that 2020. I mean, is it 2020? Yeah. 2020. Are we good to go now? So it means it's going to be 7% of this figure. 7% of this figure. What do we get? 611.
So please, how did you get 7%?
407.12. That 7% is the cost of capital in the question. That is interest. That is cost of capital in the question. Okay, so what is the addition? Okay. Addition of these two. Nine, 345, 794.39. 39 or 40? 39. Then when I look at it, that's what I was asking. Don't worry, you will be looking for the remaining 0.0001 after the calculation. Okay, so this is what we are going to recognize under liability. Do you understand now? Now, this thing has not been captured in the financial statement. That is why we are bringing this one here. And because we have used this figure already to be part of the goodwill, that is why it has to be here. Now, after this, I don't think there's any other calculation again, Abi. Yeah. So let's go to what now? Number 4. Let's call this one number 4. Let's call this one number 5. We call this one consolidated retained earnings. We should remember how to do this. What is the first thing to bring? As per statement. How much is that retained earnings? Don't forget, you are bringing the one of parents here. Yeah, 26 million, Abi. What again? Post retained earnings. Okay, post retained earnings. How much is post retained earnings? Online, what is the post retained earnings? 20 million. 26, I mean. It's 6, 7.
They have 3.